and wanna hate this, I'll always show up and make a statement. I don't ever slow up, no I don't take shit. I got no love for the fakeness. If you wanna play tough and wanna hate this, I'll always show up and make a statement. Everything I do so instinctive and so passionate. Every word I move so descriptive like an adjective. I got a vendetta against people who patented being negative when you should be getting after it. I got facts over tracks, this and that. Spitting slow, spitting fast, I could roast, I could gas. Think I'm okay at last, but I don't know if that can erase all the past. And the pettiness, a reflection of the emptiness. Hilarious, you think you're worth my time, you're delirious. Mysterious, because you hide behind a fake exterior. Inferior, you know I'll always be a bit superior. Get off of me, this ain't no humble brag. I want you to hear words, you can say them back. I want you to feel free from the chains at last, and to believe in what you got, it was built to last, yeah. Now that I've been through hell, I never got anyone's help. I had to do it all myself. I don't ever slow up, no I don't take shit. I got no love for the fakeness. If you wanna play tough and wanna hate this, I'll always show up and make a statement. I don't ever slow up, no I don't take shit. I got no love for the fakeness. If you wanna play tough and wanna hate this, I'll always show up and make a statement. Gonna learn the consequence of being incompetent. Mental health is confidence, dreams and some honestness. I'm not here to save the day, that's for you to take away. I could play a million mind games, but instead I say something not illogical, something that is topical. Rub it on and watch it go. Make yourself.
Hello. Am I on? Yeah. How's it going? You like that one? That's a new one. I got a new song. So figure I'd go hold on a second. Let me pull this. All right, I don't know if this one I might get in trouble with the YouTube algorithm for this one, but I think this is hilarious. Hold on.
Rocco, 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 our favorite rock. Rocco, 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 our favorite rock. Rocco, 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 our favorite rock.
All right. Well, you gotta love that. That was a good one. I might get canceled by Sesame Street. We'll take it. So anyways. I don't know if the Doom music, because I only use like 15 seconds. Maybe I won't get killed for the only thing they fear is you. Oh God. I listen to intervals, love their album Shape of Heart or Shape of Color. I've been finding some pretty interesting new modern rock bands lately. I love weird like stuff that's just interesting. Like I don't know, it hits your ear, you're like, not bad. Anything like Periphery. Okay, so this is supposed to be a serious investing video, kind of. But so this is something. So I originally got onto this. Dumb Money talked about this probably a year ago, and then they talked about it again, and kind of perked my interest. And I had this paper. I didn't read the book, so there's a book they wrote related to their research paper. So these two Yale economists wrote this. I don't have the book. I'm not going to do a book review on it, so I don't want to buy it. But so the idea of this. This might be crazy sounding to you if you haven't heard of life cycle investing that these two economists have proposed. So their idea is that you should use, like the long story short, is you should be using leverage when you're at your younger, when you just start out investing. You should use leverage because you need to maximize your investments into the market at an earlier age, so you have more time in the market. Additionally, it also gives you it also would apply to the time value of your wealth. So, and we'll talk about more, but you want to put, if you look at your whole wealth from like age 20, right? You present value future savings compared to what you have at that moment. If you wanted to consistently apply a certain percentage of your total wealth into the stock market, you can't do that when you're 20. You don't have the capital. So they would propose that you would have to use leverage to get the desired contributions to the market. as you get older in life, you have this goal of a certain percentage of this projected wealth you want in the stock market. As you use leverage, you get to that point, you would then start to de-lever your assets, and you're also building. You would ideally make more money every year, so you don't need leverage as much as you get older because you have more savings ability. So you could start out like 3x, like they don't go to 3x, but like conceivably there's 3x leverage and then there's 2x leverage for ETFs. I'm not going to talk about individually doing this because I think that'd probably be a bad idea. I wouldn't. They do talk about in this book where you would do this yourself. You would buy like SPY and then you would buy Leaps yourself, which I don't know. With the products out there, I don't know. I wouldn't get into that type of a mess, but I'll just cover some of the broad strokes of this. I'm not a math nerd, so like these two guys. So we'll see. Let's see. I never used leverage, never shorted, never bought calls, only buy and hold. Now, this idea is they're about optimizing your return. This is all about optimizing return. They're not looking so much at risk. They're not looking at something that could be applicable to like broad strokes of the economy. You know, people, they're looking at just like what would be an optimized investing strategy for return. Realistically, the vast majority of people out there should never touch anything like this. And I guarantee you Schwab or Vanguard would never propose you do something like this because it wouldn't make sense in their business to tell you to do something like this. So I'll cover some of the ideas of it. If you want to read this, it's here's the paper. You can download it too. If you want to buy the book, I'm sure they wrote the book in a more friendly way for people to read. I couldn't find it online. Okay. So I'll just read the abstract first. By employing leverage to gain more exposure to stocks when young, individuals can achieve diversification across time. So time weight of money, not just the dollar or not present value of money, let's say. Using stock data, they did the math going back, like the restoration. We show that buying stocks on margin when young combined with more conservative investments when older dominates standard investing strategies. So they compare it to this idea is compared in the study to 100% equity investor, and they also compare to what they call a 90-50. So when they wrote this, the idea was they were saying Schwab and Vanguard were saying their typical proposal was you start at 90%, which I covered this in my 401k. It's that kind of idea. You start at 90% equities at 20s, and then you turn the dial when you're retired, you're like 50-50 or some sort of percentage bond to equities. So I guess 50 or 90-50 was maybe what they were pushing when they wrote this paper. So what they talk about here, if you do the math, if you think about it though, if you look at your total accumulated wealth of your whole life, which I haven't really thought of this before until I read this, like even if you're 90% equities when you're 20, right? Like you're 20 to 30, you're going to be like, I'm Warren Buffett style, 90% S&P, 10% cash or something. They're like, if you actually look at the actual dollar value of your accumulated wealth projected for your whole life, you're not 90% stocks, right? Because you don't have a lot of income in your 20s. So that 90% of current savings doesn't represent a lot of your total accumulated wealth of your whole life. So they're saying you actually aren't putting 90%. If you look at your whole life, you're putting in like 50-60% of your wealth or projected savings in that time period. So they would say, so actually going beyond simply 100% equity, you need to go like leverage, right? Beyond 100% invested in equities to attain the percentage invested that you're desiring. So if you want to be 90% invested in stocks in your 20s, you'd actually need to go beyond your current savings rate if you look at it your whole life. Kind of difficult you'd have to kind of read the math to get what they're going for here. Like I said, these are economists. So we'll go through some of this. So they talk about different leverage. They have two specific leverage strategies in here. I'd rather just talk about like the simple case of what they're proposing. Okay. So they do a 2-to-1 leverage when they were looking at leverage in here. So not 3-to-1. So that's your basic options, right? For an ETF, there's a 2x and there's a 3x. Like S&P, we're talking about S&P leveraged investment products. You couldn't do this in your 401k. It's basically just your Roth or your personal brokerage account, which I don't know if you really would want to. Okay. So investors, okay. So they talk about some of the negatives, understandably, about margin. So obviously for people, a 2x represents if you had $20,000 and then you had a 2x exposure, now you borrow 20,000, right? So now you have 20,000 of your capital plus borrowed, so you have $40,000 of exposure to whatever you're investing in. That would be like a 2x margin product. So they talk, what are the risks here? Investors face the risk of being wiped out in their current investments while they're young, because they said you would do more leverage as you're younger, and as you taper the leverage as you get older when you attain the certain desired amount of equity investments for your lifetime wealth. They said, well, the highest likelihood of being wiped out, which is still doesn't happen. I think they said in their whole course of their studies, even during the Great Depression, you would not be totally wiped out doing a 2-to-1 leverage strategy like they're proposing. But even if you were, they're like, you still would have plenty of time in your life to accumulate wealth if it did wipe you out at the beginning. That's what they wrote in here. Present savings may be extinguished, but present value of future savings will never be. So they're looking at your accumulated savings of your entire working life is the way they're looking at money, not just what you were making per year and what percentage of your per year you're putting in the market. They're looking at what is the percentage are you putting into your equity, your investments, of your percentage of your total wealth projected, which is an interesting, I haven't really thought of it that way ever, I'll admit. So our simulations account for this possibility. So they did account for the potential. The risk is you could be severely wiped out in a huge correction in the market. So, in the Great Recession, S&P lost, I think, 50% at its worst. So you can imagine what the leverage products would have done during that time. So we find that minimum return strategies with initially levered positions would be substantially higher compared to minimum under traditional investment strategies. So they're building the case when you read this for why this will work. I just highlighted some of the parts. So the puzzle is why traditional life cycle strategies don't outperform the equivalent constant equity percentage. The answer is traditional life cycle portfolios don't really change their allocation. So they're talking about the current, they're talking about the 90-50 portfolio. Although nominally moving from 88 to 30% in, say, assets, the math they use, or the symbols they use here. Let's see. Since invested assets are so low during your early, this is where they're getting to, you think you're 90% stocks, but in a weighted value, you're actually probably 53%. I should zoom in. If you look at lifetime wealth. So you're actually underweighting your investments in the markets at a younger age because that's all you have. Okay, we'll go. This is probably boring as hell to most of you guys. Okay, this section. Schiller finds investing 100% of current savings in stock working life produces higher expected payoffs and even higher minimum payoffs than a conservative life cycle strategy. So they did the math. We'll see that this works better for people. You will get a better return for this strategy that they're proposing. So our contribution is to show that going beyond 100% equities improves expected utility and that the gain is substantial, a 19% increase in expected retirement wealth compared to 100% equity strategy, and a 90% increase compared to the typical 90-50 that they were referring to. So substantial outperformance over long periods of time when they back tested this. Now, I'm not the only one. I mean, there's videos about this online. This isn't new. I don't want to talk about that part. Hold on a second. So here, for most analysis, they assume a maximum leverage of 2-to-1. That's what they're going with. So I did a back test with a 2x version of the ETF. I'm not going to do the 3x because that's not what they put in their study. If you see people talking about that. Here, they do talk about how you could do this yourself with leaps. Probably not for me. Probably none of this is for me. Because obviously this idea would benefit someone to take this on when you were younger, longer time periods in the market. So here's the 4 different scenarios that they're going to run at the bottom at the bottom of the study. So they have 2 different versions of this leverage strategy where you change the percentage contribution or percentages. And then they show 100% stock, assuming you just went 100% S&P 500 your whole life, only your current savings, not projecting future savings. 90-50 represents a typical ETF package from a firm. Okay. This part was interesting. The surprise is how well leveraged strategies fare relative to 100% strategy. The dual target strategy produces a median retirement wealth that is 28% higher than 100% stocks, and an increase in the mean return of 21%. So significant outperformance based on their back testing. The higher returns of leverage do not translate. This is the important part. The higher returns of leverage do not translate into higher risk, or retirement risk. So the minimum retirement wealth, okay, go with that. So they're saying you are not increasing your risk in proportion to the amount of projected return. So that would be great, right? You're not increasing your risk over long periods of time, but you are getting a better return on your investment. So the stock market has never declined sufficiently. This is their paper. To wipe out pre-existing investments of any cohort adopting a temporarily diversified strategy. So that's what they're saying. They didn't find any periods that they looked at where this strategy would have been completely wiped out. But they can't say it's not possible, because if you're using leverage, it is possible. But they could not find a period where that did happen. And they back tested beyond like the Great Depression, that far back. They also did this for the Nikkei. They back tested 50 years of data for the Japanese market, and they had similar outperformance to the. So it's not just the S&P. They also checked the Japanese market, similar returns with using leverage. So this part, conclusion. Our recommend investment strategy is simple to follow. An investor who targets a single percentage or single present dollar value follows 3 phases. The worker begins by investing 200% of their current savings. So it means you're using projected total wealth in the stock, in a equity, let's say the S&P 500, until a target level of investment is achieved. So like lifetime wealth. So you'd be like, I want 50% of my wealth to be in equities, and you do this projecting the current savings and future projected. You say, oh, I'm gonna have $1 million, and then you would do the percentages you would need to per year to achieve that. Which means, yeah, you'd have to borrow, either leverage products, or it would mean borrowing. Like, I don't know if you want to do that, borrowing like personal loans or something. Eesh, boy. So there are products to do this. I don't know why you'd do it that way. Okay. So they talk about here savings contributions compared to the present value of future. So like, as you can see, you have your savings in present dollars is lowest at the start, but if you look at it as the present value of your future contributions, they are higher when you're younger. So they would say you can take more risk on because you are not really destroying future contributions and wealth that you accumulate in your life. You in your younger age, you can make those risks because you have time on your side. So that's why they say you should take on leverage, because here you can take an acceptable level of risk, and it's not going to adversely really harm you, is what they would tell you based on that chart. Don't worry, I'm kind of confusing myself here. It's okay. Oh, I don't want to go over that one. No. Okay, here. So here's where they start actually doing the mean comparison. So here's like a typical Vanguard strategy that would, present value 90 to 50 over your life, all S&P. Then there are 2 different versions of this leverage strategy, which don't really change the outcome. But you can see, outperformance by a significant degree over long periods of time. So there are 2 strategies represented 19 to 21% outperformance of just being 100% equities present savings, using leverage. So here we go. I don't think any of the other charts really matter too much. It's kind of the same repetitive stuff they went over. Okay. Yeah. Impact of higher leverage caps. So they do consider margin requirements of, because I don't know if these ETF products were in existence when they started this. So they looked at, like, if you actually were to do this yourself with Leaps, there are margin requirements. There are fees, attached to doing this yourself. There's also tax implications to this. They did factor some of that in. All right, I don't want to go over this anymore. So let me go over some stuff online, and then we'll get out of here. Hold on a second. Where'd it go? Okay. So I've covered this before. Does anyone have any questions? I invest in SoFi using leverage. So I saw Echoes made a joke about SoFi, and then in his video making fun of Jeremy, and then you could see like 5 people underneath were like, "What's wrong with SoFi? What's wrong with SoFi?" I was like, "Okay." And then I enjoyed the Copium live streams last night. All of their freaking bragging about their 20% jump. I'm like, "Okay, cool. Wow, short term, your stock went up, and then it came right back down." Well, I enjoyed that. I never use leverage. Okay. Yep. Just tell me where I can 10x. Yeah, I will. So we will do a course, a life cycle course. I will teach you how to do it before I do it. There. How about that? I'm gonna try 100% leverage. Damn. What did Bill Huang got up to 9 levels of leverage? I think it's like an achievement. But so you can see, like, when I talked about like bonds in the retirement videos, if you like volatility and drawdown and all that, in the end, like over long periods of time, like who really cares is what I would tell. Like, who cares? If your horizon of investing is 30, 40 years, like what do you care about volatility and drawdown, right? Like you should be, someone would argue like you should worry about maximizing return, risk adjusted return. And you shouldn't be so concerned about volatility because you're not going to take that money out. You're not going to touch it. So you should worry about calculated risks in the market to maximize what you can get out. And this is what Chris Camillo talks about on Dumb Money a lot, which you should listen to him because it is an interesting opinion of someone, like a very different type of investor than someone like us, most of us. But you can see the point, like in this chart I've showed before, 100% stocks, right? Yeah, high volatility, the highs are high, the lows are low, but the return on average is better. So in the end, like we've said, like volatility in long periods of time really doesn't matter for you. The only question is how much can you take? How much can you take as a person? When the Great Recession happened, could you have taken a 50% drop in your portfolio and not freaked out and not sold it? That's what matters. It's not about long-term performance when you're talking about the volatility. It's just a matter of you, the person. Can you deal with it? Because if you had like 20, 30% bond exposure in 08, it would have only gone down like 30%. Maybe you could have handled that better than a 50% drop, because a lot of people couldn't handle that and they sold. So that's all that it matters. I'm still all 100% equities because I have a pension. I can take those risks. I don't need protection because I could just get to retirement, not even draw my retirement if the market's doing poorly. I can adapt to it. So I don't need drawdown protection. That's my situation. Maybe you think you can handle it, but you can't actually. I mean, if you're the type of person that wants to sell an equity because it's red, wait 30 days and then buy it back just so it looks green on your brokerage account, which people do that, like you should probably think about who you are as an investor, because that is telling me something about who you are and the risk you're willing to take. If you just are so desperate just to see green on your brokerage account. And the other benefit of this leverage, and this is more my opinion, not the study. So this is a really, I wish this chart was clear. I really like this chart. Let's see if I can, it looks terrible. I know. I tried to find a better version of it, but the longer you're invested in the market, the better your chance of a positive result, I guess is the way I'd put it. So this leveraged approach that they're proposing would say, you're taking more of your lifetime investment. If you start with leverage, you're taking more of your lifetime investments in the market and putting them longer time periods in your 20, so maybe 40 years rather than 25 years average time in the market, right? With this leverage approach. So you can see over longer periods of time, you perform better in the market. So they're maximizing the time period. The time weighted value of your investments are maximized using leverage in these scenarios. So this is the best way I could show it. So you can see here, like you are much more likely after 20 years, you're almost 100%. It's like 90, right? Potential gain of 18% to 3% down. Which is the opposite of gambling. Gambling would be the reverse of this. The longer you do it, the more likely you are to get your butt whooped. So that would be a positive I would see of this. I'm not doing, like, again, like I'm 40. So a lot of this leveraged approach benefit, I mean, this is not for me because I'm halfway there. So I don't see how this would work for me. Now, say we took say you did this like February 2010, like this was when I had a really good investment in the Great Recession, and then say I decided to do this strategy from that point, right? I don't like to back test really far. So like SPY, I did QQQ, and then I did SSO, which is the ProShares 2x leverage S&P, which is the one I would say follows the study the closest. So over long periods of, so this is a pretty long period. I don't think we need to go to 50 years. Okay. Like I don't back test beyond 2000 because I think .com is as appropriate. You should go back to. So you can see huge outperformance of this strategy. I always start with 100,000 start just because I feel like it. You can see you've done amazingly if you did this, right? If we and when you can look worst year, yeah, the worst years are worse. The drawdowns are pretty damn sharp, right? But if you could hold on and you could stand it, this does perform. And now the interesting part in the study, you remember they said that you maximize your return and you're not really increasing your risk. So if you look at the Sharpe and Sortino ratios between the SPY and this, they're not really that different. So that does hold up from what the study is to some degree. So this is very interesting. There's an economic paper. There's now investment products that kind of suit this, which I don't know if they had those investment products. So it's interesting. The question is, could you handle this, right? Are you the type of person that could handle using leverage like this in this systematic approach? You'd have to be in the weeds about the math. So this is a big investment of your own personal time to understand how much leverage you need to attain this goal. And then you have to taper that off at a certain age rather than just something like buying the S&P, with whatever your present value or savings is every year. You don't have to overthink it. It's easy. You sleep at night well. You don't have a heart attack if the market goes down. Because if you're doing this, last year, the market went down, I think 22%. So you took almost a half, you lost almost 50% in this. I don't know how can you take that? But it's showing over the longer the time frames, the more this works actually. So if I drew this out further, you would see even better results. So this is interesting. Let's see who else is here. 40. You're old. I'm just 39. Thank you. Strongman, 130%. His return as VT for 12 years is pretty impressive. Like, Strongman is vastly better off than like he's better off than like 90-something% of people on YouTube that talk about like finance. Someone that just saved responsibly and didn't change their strategy all the time. I think a lot of people should just be focused on getting to the goal. Like this is for someone that wants to maximize their return and they have the will and the understanding to do something like this. And the ability to stick to it even when it looks terrible and keep buying. Most people couldn't do this leverage strategy. You'll never see this at a Schwab or Vanguard because honestly, they shouldn't be proposing something like this to broad swaths of people in America. The vast majority of people in America, if they're not financially apt at all, I'm trying just to get them to buy one thing in retirement, like a Roth or whatever, like one thing. I can't even explain 2 investment products to them. And you can see their eyes start to roll and they just don't give a shit. So like you pretty much that's why it's like, I'll tell them like S&P or I'll tell them like a target date because I can't even say like do US and an international and split them. Like I already lost them if I do that. So like most people I talk to, I'm like, all right, you're a normal person. You're not stupid. You're just a normal person. Doesn't really give a shit about this stuff. Like, cool, we can deal with that. I can still get you there. But this is for like a smaller, more risk-taking like group of people I could see. So I don't know. This is presented to you. There is research backing this up to some degree. So yeah, I find it interesting. No, we don't need that. So these guys have 2 videos about because Dave Hansen, there's 2 videos. They did one a year ago. That's the title, Triple Leverage ETF Long-Term Hold. So he did it about a year ago. And then they just did a video January 4th where they talk about again the leverage because Chris Camillo does very aggressive individual stock leveraged investing pretty much all the time. Dave Hansen, his Roth, he says in this video, his Roth is basically all leveraged ETFs at this point. And he did this a few years ago, and he has done amazing with it. If you run I think he started this before COVID, he said. So you can go look at the charts of like, what's it, UPRO's the 3X, I think he did. And, he's vastly outperformed everyone. So it's worked out well for these two. So here's one product that he uses. Like I said, this is the 3X, whereas the study would tell you the max you should do is all their information came from 2 to 1 leverage, which they have another product, which would be SSO. Yeah. So this is the 2X leveraged product of the S&P 500. So now it's a daily target fund, right? So I don't know if you could find a fund that's doing year-long leap contracts on this type of an investment idea with leverage. So this is the two that I constantly see talked about for people online that talk about this life cycle investing. So you can see what it does. They have they do these leverage products, right? Here's all their leverage products with various different banks, which you'll see products like JEPI has ELNs with banks. That's how they generate their freaking distributions. So these are contracts with various banks that they have for this for the leverage. UBS, Citibank, Bank of America, Goldman's. I don't know what this must be, a French bank. Goldman Sachs, and then it's just market weighted holdings of the S&P below it, right? So, and then you're paying a higher fee, but if you backtest, the returns do outperform even with the higher fee. And the thing that's interesting is like if you were to actually borrow the money, I tried to roughly do the math when I had time before this. Like if you were going to borrow the money yourself to do this leverage strategy in like a personal loan, you would pay so much more fees than just using these margin products. So the borrowed capital that you're really not paying a lot for it if you think about it with these products. Only what is it, a 1 or 0.9% fee expense ratio, 0.89. So you could argue you're borrowing capital at a very, very low rate compared to what you could do personally for this strategy. So anyways, what else to show? One video I wanted to, I'm going to stop this. Hold on a second. Oh, I'm going to try to pull this one up. Wait, I don't think hold on a second. Okay, audio shared. So he did a short, he's talked about this in other videos. I think it was an interesting clip. He's a very different investor than most of you see online. Oh.
It literally almost doesn't matter over the long term if you have it bucketed correctly, right? That's what's so fascinating. Like everyone's like, I don't want to take a 90% drawdown on my money. I don't want to lose 90% or 95% of my money. Like that's crazy. Is it? If you're investing for a few decades, like, is it the end of the world if you have 1 or 2 times when you have a 90% drawdown? If the rest of the time your money's compounding at like 25%, 30%, right? Like, it's a mindset. But risk doesn't.
So it's kind of a different take than I think you hear a lot. So my big problem with people that like invest in things like SoFi, and a lot of these so-called growth investors, I kind of trying to make this easier to describe, but they're not taking appropriate calculated risk, right? Adjusted risk. They're taking on the potential downside of an investment without the potential upsides of taking that risk. And they don't understand that. I know they don't, because they don't talk about it ever. But the potential, like this strategy is researched, right? So it has potential down. It also shows the high likelihood of a potential upside return on the risk you're taking. If you're buying something like SoFi, I find it hard to believe that your risk adjusted return makes sense on something like that. So like you're taking a lot of risk. A lot of things can go terribly wrong with something like SoFi. Like, okay, the upside, what they crush the financial market. Every bank in the world starts using Galileo and they take over as the payday lender of the world. Like I don't think you understand the upside compared to the potential risks of investing if you make that a large amount of if you want to make a small play on something like that, good luck. But risk adjusted return, and that's what Chris Camillo talks about. You should take risk in your portfolio. He talks about baskets. You'd have to watch his videos more to understand, but risk can be managed and you can use it to your advantage if you can handle it. Can you handle it, right? Could you handle something getting blasted by the market and hold on to it? And you could look at last year. It's not a leverage example, but SCHG, right? I held it last year. It got obliterated for the most part with all the tech investing. So if I pull it up, and there's plenty of examples I could pull of this, but I mean, obviously, what's the risk? I mean, this is not a leverage, so this like not the craziest risk, but okay. So 2022, we started at 80 and it drew all the way down by the end of the year to 55. So 80 to 55, 80. You know, I took a 32% nosedive on SCHG in 2022, like 32%. So right, that's not 50%, but that's 32%. What if I had sold it, right? And now it's what it's back. Now it's a gain from that 2-year period. So any strategy really doesn't matter in the markets if you can't stay with it. Because there are probably a lot of people out there won't admit it. They probably sold a lot of their growth investments at the end of 2022. Everything was 20-30% down. They just couldn't take it anymore. Okay, well, you shouldn't have been a growth investor is what I would tell you, because growth investing over long periods of time can be great. But if you can't handle that, then you shouldn't fucking do it. You should be a VT investor if you couldn't handle that, where you didn't get clobbered by 32%. So any investing strategy people propose online, it's all the same. Can you stick to it? Can you stick the course? SCHD investors bailing on that. Okay, you couldn't stick the course on something, so you probably shouldn't have done it in the first place, I guess. So that's all that really matters. Why it's no downside, only volatility. Oh, and when it went 20%, like I'm just like, cool, short term, you're still bag holding because it was $10 when it went public. All the channels you look online were buying it $12, $13, $14, $15 a share. So they're all bag holding, while large cap tech has just blasted all of it. I don't understand why you would be in those type of investments. Small company, or it's not even small, it's a mid cap. So mid cap growth, like, where does it make sense to be in mid cap growth? I don't see any research to say that's where it is. I think large cap growth is where you should be. And then potentially I'm looking at, with factor investing, do you pair large cap growth with small cap value? I'm kind of in between at this point. It's my own personal research on, do I transition to a factor investor? Now I don't know, like if I was 20 and I had read with what I know now about investing and I read that leverage research, would I have done it? Honestly, I don't know. I don't know if I would have, because again, I don't know if could the 21-year-old me have understood that and implemented that, or 25-year-old. I was still shoveling concrete at a pool company at 25. So I don't know if I would have understood enough of that to be careful and confident enough to do a leverage strategy. So it is what it is. Igor. So that's this video. Thanks for listening. Maybe you got something out of this. I don't know I'm undecided about doing factor investing videos because it's still new to me to understand it. I could do a review of some of the factor investing vehicles I'm looking at, the ETFs. I don't want to propose I'm some sort of expert on factor investing because it's just intriguing at this point. I'll probably do a review. Like there's a few ETFs that were related to it. Maybe I could approach it that way. So we'll see. So anyways, thanks for listening, and we will see you later on sunset. Where'd it go? Dang, my intro. Okay, here it is. Bye.
Thank you for your cooperation. Good night.
I'll buy that for $1.